Hello. This month I'm going to cover one of the things that happens behind the scenes in the advice and investment management industry that is really important for protecting clients and helping them to achieve their objectives. But actually it's something that is, in my view, quite badly done by most people in the industry. And some of the things about it, underneath it all, are not very obvious. The subject I want to talk about is how do you select the most suitable fund or investment solution for a client's needs in each situation. There are over 100,000 funds available globally. So actually taking that huge number of funds and bringing it down to a group which we can analyse in a practical way is the first challenge that you have. There are a number of factors that you can use which are quite predictive of the likelihood for a fund to perform well. So we screen those funds down by looking for excluding all funds that have costs which are higher than a level that we think is appropriate. Looking for funds which are of a reasonable size in companies which have stability to make sure that any fund that we selected was likely to still be here 3, 4, 5, 6 years from now. We also, of course, look at track record. I'm going to talk more about that in a second, but we do look for evidence of skill. And we look for funds which are designed to deliver a certain risk mandate because that is what our clients need. So funds that aren't targeted around risk aren't appropriate for us. As you'd imagine, once you've applied those criteria, you can hugely reduce the list of potential funds from hundreds of thousands actually down to hundreds. It's the next part which is really interesting though, and about what you do with those funds and how you analyse it, and this is what I think is going to be most surprising for people. We use 3 criteria when we're looking at funds. The first is we look at risk-adjusted return. I have another video in this series I've produced going into this in some detail, but to summarise, most fund managers effectively cheat their way to try and get better performance by running consistently higher risk than the average manager would normally do in the area in which they're competing. So it's quite technical sounding, but the fund managers make sure they're able to adhere loosely to a benchmark, and then they tend to, these people who fall foul of this problem, tend to turn lots of areas in the portfolio up to increase the risk. Now, of course, over time, the more risk that you run, the higher your returns will be, but it is of no benefit to clients whatsoever because we've selected a risk profile that gives the clients the best chance to meet their objectives. The last thing we want is fund managers trying to generate better performance by pushing the boundaries all the time. That's the first thing that we look at, risk-adjusted returns. Very few people seem to do it, and it's incredibly important for improving chances for clients. The second thing is we look for hidden risks. Now, what do I mean by that? I mean risks that are embedded within a portfolio that perhaps haven't yet come out in the track record that the fund has. So you can't see it from looking at the track record, but if you look underneath, you can see it. So a great example would be Neil Woodford's funds. I'm sorry to be another person jumping on the bandwagon criticising him, but it was very obvious to us years before he had a problem that he was veering off into a strategy where he didn't have a significant track record or expertise, but he was also buying into a lot of companies that were very illiquid, very difficult to sell. The structural problem, of course, is as soon as his fund started shrinking, he couldn't sell the assets which were hard to sell. He had to sell everything else. So the assets which were hard to sell became a bigger and bigger part of the portfolio. It was a very clear hidden risk. At the moment we identified this, any clients that we had exposure to that fund were asked to remove it. And it wasn't actually a surprise to us when the portfolio ultimately ended up in the problems that it did. More generally, we don't like property, another example of a hidden risk. The reason we don't like property is that people use it as a way of diversifying risk away from equities. However, every time risk arrives on the scene, property funds close. It's like a guard dog that faints whenever there's a security incident. It completely doesn't do the job it's meant to do. So it might look good during good times, but actually, when you have risk, it's a serious problem. We generally don't like illiquidity for that reason. We tend to be quite sceptical of absolute return funds because a lot of them are hiding market risk within them. And there are a whole range of other things you can potentially look at, but hidden risks are a big issue for us. We try and look behind the scenes to see what might happen next. In a similar vein, the third thing we look at is we try and project forward likely future risk and returns. Today's a great example of this because actually there are a lot of asset classes globally that look very expensive and offer a very poor outlook for returns and risk from here. We particularly think this is true of large sections of the US stock market. We think it's true of the high yield junk bond market. And we think it's true of this thing called growth investing. An awful lot of funds that we see are very heavily exposed to these kind of investments. Now, if you look at the track record, a lot of them would have performed very well recently, but the outlook for returns and risk, in our view, is very poor. So the last thing we do is we look through all funds, look through at the underlying assets that they own, and try and find the ones, try and remove the ones which are exposed to assets which we think are going to perform very poorly in the next 3 to 5 years. So just to summarise what we do, we analyse using quantitative filters the entire universe of available fund solutions to come down to a list of ones that we think, using those filters, have identified skill, they're low cost, they have discipline, and they're stable and robust. And we make sure they're risk targeted as well. But then after that, we look at analyse properly risk-adjusted returns to make sure we're getting value and they're likely to deliver to the mandates that we give them for clients. We look for hidden risks within the portfolio, with most funds appear to have some form of hidden risk or other. And lastly, we look at our projection for what the likely outlook of that fund is going to be based on current asset allocation. And the result of this process for us has actually been extremely successful in preempting problems and being able to spot issues in funds and solutions before they become a problem for our clients. So just like any other part of this series, if you have any questions about this topic, please get in contact with me. I'll be absolutely delighted to help you. As with everything I've been talking about, I'm talking about investments in this series. Every single time I talk about them, you must be aware that your capital is at risk with any money that you invest. And the last thing I want to remind you of is if you click on the button which appears at the side and the bottom of this screen, you do have the opportunity to follow these videos as they become available and to automatically see them. Thank you.